So welcome back to another tutorial session. Today we'll be looking at the financial cycle. And what is the financial cycle? Well, really it's the process of identifying, analyzing and recording accounting events and transactions within a business. So let's take a closer look at what that looks like. So the financial accounting cycle really starts with a business transaction. And with that business transaction, you'll analyze it. And then the first thing that you will do after analyzing is recording it in the journal, the general journal, after which you post it to the respective ledger accounts, or otherwise known as T accounts. So once you've recorded all these transactions in the ledgers and the journals, then you close them and then move them to the unadjusted trial balance. It's unadjusted because though you might be finished, you might have made some errors and mistakes. So after you've done your unadjusted trial balance, you will go over and you'll see if there's any adjustments to be made. And if there's any adjustments to be made, you'll start over with analyzing and recording it in the journal, posting it in the ledger. And from those adjustments, you now have your adjusted trial balance. From your trial balance, that's where you will prepare your final accounts. And final accounts are your financial statements, such as your income statements, your balance sheets, and those others. So once you've finished those, then you do your post-closing trial balance. So let's look at the question ahead. The question ahead, we'll be doing some of the events here. We'll be participating and engaging in the accounting cycle and preparing stuff in regards to the accounting cycle. So let's go. So today's question. Will started a consulting business and during the first month of operations, June 2008, completed the following transactions. And we have transactions from A to K going down. We'll analyze them and look at them in detail a bit more or a bit later. What is required of us? Record each transaction in the journal. Use the letters to identify the transaction, and the letters are there, A to K. 2, post the entries to the ledger accounts. 3, prepare the trial balance of Wills Consulting at June 30th, 2008. And 4, prepare the income statement, the statements of owner's equity for Wills Consulting for the month ended June 30th, 2008, and the balance sheet as at that date. A bit much, a bit lengthy, but we will get through it. But just to backtrack, let us see, based on the question, what are we doing? We have the transaction, so we're starting with business transaction. It says in 1, do the ledger, so the recording in our ledgers. Then it says, post the entries to the journal, to the ledger, So, we'll be going to post to the ledger. Then it says in part 3, prepare the trial balance of Wills Consulting. Then prepare the income statement and the other final statements. What we can see here is that we're skipping out the adjustment section. So what this means is that our trial balance will be balanced and correct for this question, and it should be in order for us to prepare final accounts, because if your trial balance is not balanced and not correct with the proper information, your final accounts will not be. So you can see in accounts, if you made an error previously, it will most likely be carried forward. All right, so let's continue. We have a question, but let's just look ahead at some definitions. So the general journal. The general journal is a book of original entry. Transactions are usually listed in date of order or chronological order. And each transaction is recorded in the general journal, followed by a narration. And a narration is simply just explaining what the transaction was in. This activity here, this question here, I did not include any narrations, but they're simple, that you can easily write a sentence. That's all it requires. So what our general journal looks like and what is included? Well, you have your date, you have a column for description and a column for debit entry and credit entry. Because when you're journalizing something, you're doing that's the basic, the first step in the accounting cycle, right? Where, okay, the concept of debit and credit comes about here, and hence why you have the column for debit and the column for credit. Then we go to the T account leisure, and that was part 2 where it says post to the leisure. And this is what a basic leisure looks like. It's a T account. That's another name for it because it looks like a T. Where on our left side is our debit side, and on our right side, we have our credit side, right? And based on the different types of accounts, you know when one increases, you debit, or when it decreases, you credit, and vice versa. So let's go. This is the setup of our journal. And instead of date, in the far left column, we have 1 because the question says to use the letters to identify the transaction. So there won't be any date, but the letters of the alphabet. Next is followed by the description on the accounts and explanations. And then we have our credit column and our debit column. So let's go. So let's go back to the question. Our question says, A, Will began the business with an investment of $25,000 cash and a building valued at $30,000. The business gave Will the owner's equity in the firm. How will we record this transaction? And point to note, we'll be doing 1 and 2 simultaneously. So we'll be doing the journal entry and posting to the ledger accounts at the same time. So after we've done the journal entry, we'll move on to doing the ledger accounts. And this is to ensure that we don't miss anything. Yes, you could have done the journals first and then start over by going over again and doing the ledger accounts, but we're doing the journals and the ledger simultaneously. So the owner invested $25,000 cash and a building, right? We're giving Will the owner's equity in the firm. So we're seeing here, if you made an investment of cash in your business, cash will increase. And cash as an asset, when it increases, you debit, right? The same for building. When it increases, we debit. So we're seeing here, okay, we'll have a debit of cash, but what's the opposite side of the transaction? What's the other side to the transaction? Because for every debit, there needs to be a credit. So where is the credit to this? The owner invested it. So this is owner's capital, owner's equity. And when equity increases, we credit it. So we can see for the first part of the investment of cash, we're debiting cash, $25,000, and we're crediting owner's equity, $30,000. And we can say the same for building because building is an asset and the owner invested it. So building is increasing as an asset. When it increases, we debit. So it's a debit to building of $30,000 and a credit to capital of $30,000. So let's look how that looks here. So we're seeing it here. What you're seeing on your screen though is me putting this transaction in one, and we call it a compound, a single compound entry, where instead of splitting it up, because that's how we explained it just now, when we debited cash and then debited capital, then debited building, and then debited capital again, that was separating the transaction in two. However, we're putting it together. We're seeing that capital is common to both transactions. So we've summed it, and we've summed it to be $55,000, a credit of 55, and you have the various debits of cash and building. So let's continue. So now that we've done the journal, let's look at what our ledger looks like. So our ledger for this transaction would look something like this. Remember, our ledger is a T account, right? And we're starting with building. So remember, in our journal, we had a debit to cash, a debit to building, and a credit to capital, right? So here, remember in your T account, on your left side is your debit side, and on your right side is your credit side. From our journal entry, we can see we debited building $30,000, and we also debited cash 25. And in our capital, we credited both respectively. So whatever you've written in your journal, you come to your T account, to your leisure, and you put it on the side that you have stated it to have been in your journal. All right, so let's continue. B, so you purchased office supplies on account for $2,100. So this is a purchase. So resources is leaving. What did we purchase? Office supplies. And the office supplies here is an asset. So asset is increasing, we're debiting. So the office supplies asset account, we're going to be debiting it $2,100, right? How did we make this purchase? We made it on account, and on account simply means on credit, right? So this is something we're going to be paying in the future. This is now a liability. So this is an accounts payable. An accounts payable, a liability, when it increases, we credit. So here we're seeing the transaction debiting office supplies 2,100 and crediting accounts payable 2,100. Point to note, you can actually write the word debit and credit. However, in accounts, to denote a debit and a credit, to denote a debit is in the margin line. So when you're denoting the credit, you just indent a little bit, as you can see here. All right, so let's look at the leisure for this. So the leisure would look like this. We're in our office supplies account. You're having the debit of $2,100, and in your accounts payable account, you're seeing the credit of $2,100. The letters beside the number is simply just to identify the transaction that we're doing. So let's continue. C, you paid $18,000 for office furniture. So again, we're making a purchase. And what did we buy? Office furniture, right? And office furniture is it's an asset. So you purchased an asset, it is increasing. So our office furniture assets account is increasing. And when our asset increases, we debit. So the first thing here, we're debiting office furniture, $18,000. This was a purchase. How did we pay for it? We paid it. It was not like in B where it said on account. So we paid this. So this is resources of cash leaving the business, and cash is an asset. And when our asset reduces, we credit it. So here, the journal entry for this transaction is a debit to office furniture of $18,000 and a credit to cash of $18,000. What does the leisure looks like for this? Or office furniture leisure on the debit side, we're seeing $18,000, and in our cash. So remember in part A, something had happened in cash before, and now another transaction is taking place. So we leave it. So every transaction stays until the period is finished and we're closing off to move our balances to our trial balance. So let's continue. D, paid employees salary, $2,200. So we're seeing here, you paid something. So our cash again is being reduced. So cash is an asset, and when assets reduce, we credit. So we're seeing a credit of $2,200 for cash. But what did we pay? We paid salary. So what is salary to the business? What is employee salary in a business? It's an expense. And when our expenses increase, or once our expenses incurred, it's debited. So here, or journal entry for this transaction is a debit salary expense of 2,200 and a credit to cash of the same 2,200. Now let's look at what this looks like in our journals. So our salary expense account, debit 2,200, and in our cash we can see transaction D on the credit side 2,200. Let's move on. E, performed consulting service on account 5,100. So you are a consulting business, so whatever service you'll be doing for others is consulting services, right? So you perform this service, you did it. This is the purpose your business was established, and your form of earning revenue is doing consulting services for persons. So once you perform this service, you have earned your revenue. So here we're seeing where service revenue that is earned is taking place here. And what we know about service revenue, we know that once you've performed it, you've earned it. And once you've earned it, it is increasing, and an increase in service revenue signifies a credit to the account, right? So we're seeing here, we're going to be crediting service revenue account, right? And what's the opposite side to this transaction? It says you performed it on account. So you performed it on credit to someone else. So that is now an accounts receivable. So this is money to be received, and this is increasing, right? So accounts receivable, what type of account is it? It's an asset. And when our asset increases, we debit. So the journal entry for this transaction is a debit to accounts receivable and a credit to our service revenue of $5,100. So, and this is what it looks like in your ledger accounts. Let's move to the other transaction. So you paid $800 on the account payable created in transaction B. So we're seeing here in a business, something might have happened earlier, and then something happened days after that relates to what happened earlier. And this is really it. So let's look back in B. What happened in B? You purchased office supplies on account on credit. So if you purchase something on credit in the future, you will definitely have to pay for it. So if now you are paying for it, that means one, your cash is now reducing, and your cash is an asset. And when our asset reduces, we credit. And the second thing that is happening is your accounts payable is reducing because you're now paying this person, and our accounts payable is a liability. And when our liabilities reduces, we debit it. So we're seeing here where the journal entry for this transaction is a debit to accounts payable and a credit to cash of $800. What does this look like in your ledger? Let's see. So you're seeing on the debit side of your accounts payable, 800. Remember, you had 2,100 on the credit, right? Because it's increasing, but because you're paying it now, it will reduce. And you're seeing $8,000 in your cash account, signifying an outflow of cash. Let's move on. G, received a $600 bill for advertising expense that will be paid in the near future. And based on what we've learned prior and in B, paid in the near future, this is what? This is a liability. So our accounts payable, right? Our accounts payable is increasing here, right? And when our accounts payable increases, we credit it. And what's the opposite side to this? What is it that we're paying in the near future? An expense. advertising expense. So we're seeing here advertising expense has now increased by $600. And advertising expense, when we see our expense increases, what we do, we debit. So the journal entry for this transaction is a debit to account to advertising expense 600 and a credit to our accounts payable of $600. Let's look at the ledger entry. And let's look at the next transaction. So we performed consulting service for customers, but we received cash of $1,600. So we've received cash. Cash is an asset. And when our asset increases, we debit. So the first part here is a debit to cash, $1,600. What did we do though to get this cash? We performed service. So we're seeing here our service revenue is increasing. And when our service revenue increases, we credit. So the entries here is a debit to cash of $1,600 and a credit to service revenue of $1,600. What does this look like in our ledger? We're seeing on the debit side of cash, $1,600, and on the credit side of service revenue, $1,600. Let's continue. 2I. We received cash on account, $1,200. So the first part, we received what? Cash. So cash is an asset, as we've said before, and when our assets increase, we'll be debiting. So the first part of our entry is a debit to cash, $1,200. How did we receive this cash or what? On account. And remember, what did we say on account means? It means on credit. So this is saying you received cash from someone who owed you before. And persons who owe you in your business, they're called accounts receivable. So when they have cleared their balance is reducing, right? An account receivable is an asset. When it reduces, we credit. So here, the journal entry for this transaction is a debit to cash because we've received it, and a credit to accounts receivable because the amount owable to us is now reducing. And we're seeing here the journal entries. Let's look at J. So we paid the following cash expenses and made a single compound entry, right? So first, let's look at this big jargon, this phrase, single compound entry. We spoke about it in A, right? And what did we say? We can separate a transaction, right? And have two separate entries. However, when we want to make them a single compound entry, we find something that is common to both, right? And we try to scoop it instead of having two separate transactions into one transaction. So the following are cash expenses. So both are paid for with cash. So we're seeing here what's common to both. Their expenses paid for with cash. They're separate expenses, but both were paid for using one method of cash. So we're seeing here what will be common in both. Cash is common in both. So how do we record this journal entry? They're both expenses, and once an expense is incurred, it's increasing and we debit. So we're debiting equipment rental services, $700, and utilities, $400. But we're crediting cash, the sum of both, to make it a single compound entry. If we wanted it to be separate entries, we would have had cash twice. Where after equipment rental, we would have had a credit to cash, $700. And then after utilities expense, we would have another credit to cash, $400. But we want to put it in one entry, a single compound entry. So what does this look like in your ledger? So you're seeing J in our equipment rental T account, in our ledger account, a debit of $700, and likewise for utilities, however, for the amount of $400. But in our cash, We could have chosen to write 700 and 400, but because it's a single component entry, it's the sum that we credit. So for the last transaction, we withdrew $3,000 for personal use. So here what we're taking from the business and we're taking cash. And cash is an asset. And when our asset reduces, we credit. So we're seeing here where we'll be crediting cash, $3,000. And because it's the owner who took this, we call this withdrawals or drawings, and we'll be debiting that account. And this is what it looks like in your leisure or T account. So based on what the question would have asked, we would have done part 1 and 2 already. So we're killing 2 birds with 1 stone in one time. We could have chosen to have done all the journal entries before, and then after we've done all the journal entries, we would go back to A, and then we'll do the T account for cash, putting the 25, the T account for building, and so on and so forth. But a lot of time that can be time consuming. So here we've just done both at the same time. So what was the next requirement? The next requirement was to prepare the trial balance. But do we have all the information for the trial balance? Not necessarily. So what goes from our accounting cycle? We do the journals, then we do the ledgers, and from the ledgers we move to our trial balance. So we have a lot of ledgers open. But in order to do our trial balance, we need to close our T accounts or leisure accounts. So let's close our T accounts. But how do we do that? What are the steps in doing this? So we know that we would have had some transactions recorded for the period. So in order to do our trial balance, we have to find the necessary balance on our leisure accounts. And how do we go about doing that? First, we're going to be totaling both sides of our T account and finding the larger total. After we've done that, we will put the larger total in the total box on either the debit side and the credit side, right? Then we will calculate the difference between the two totals that we would have obtained in part 1. Then we'll be inserting that difference found on the side of the lesser of the two to the total amount in the total box. So let's clear that up. We're going to be inserting the difference on the side of the lesser of the two to total the amount in the total box. We will call this the balancing figure, balance CF, balance carried forward, or balance CD, balance carried down. Either notations is fine. After which is the final step, we'll carry down the balance diagonally. What that means on the opposite side. And we'll call it balance BF, balance brought forward, or balance BD, balance brought down. So let's see how this looks. So remember, we would have had our building account, and here we only had one entry in our building account, and that was from part A of $30,000. So let's close our building account. So the first step says what? We are going to be totaling both sides of the T account and finding the larger total. So here we will look and we'll see, okay, building, we're totaling both sides. On the debit side, you have 30,000, and on the credit side, you have 0. So we would have known what side is the larger, the debit side of 30. So we've made note of that. The next point says, put the larger total in the total box on both the debit side and the credit side. So the larger of the two is $30,000. So we're putting that in the total box of our account. After which, the third thing we're going to be doing is finding the difference of the two sides. And the difference is 30 because the debit side has 30,000 and the credit side had 0, right? So 30 minus 0 is $30,000. And we're inserting the lesser, we're inserting this difference, on the side of the lesser of the two. And the side with the least amount is our credit side. So we'll be inserting that 30,000 on the credit side, and we'll be calling it balance CD, balance carried down. Then our last step is to put that same figure that we have balance CD on the opposite side, the diagonal side, and we'll be calling it balance BD, right? And there we have closed our building account. Let's look at our capital account, and we're just taking the account as how we would have done it, the ledger account in the same order that we would have done it previously. So in our capital account, we have two entries, and it's looking a little bit similar to our building where we're only seeing transactions on one side. So here we know that we're totaling both sides, and the total of both sides would have been $55,000. So we're putting those $55,000 in the total column. Then we'll be finding the difference between both sides. Right, the difference between both sides, one side had 0 and one had 55. The difference is 55, right? So that difference we're putting on the side, which is the lesser of the two, and that would have been our debit side. We're calling it balance CD. Then we'll be putting that balance, transferring it rather, on the opposite side diagonally and calling that balance BD, right? Or BF. Now let's look at a more complex account, cash, where we had transactions and we had events happening on both sides, on the debit side and on the credit side, to get a more realistic feel of what an account would look like. So the first transaction says we're going to be totaling both sides of the T account and finding the larger of the total. When we would have sum our debit side, we would have gotten 27,800. And when we would have total our credit side, we would have gotten 25,100. So it says we find the larger of the two. The larger of the two is our 27,800. And we'll be putting that, the larger total, in the total box on both the credit and the debit side. After which, we're going to be calculating the difference between the two totals that we would have calculated in part 1. So it's a difference between 27,800 on the debit side and 25,100. That difference, we're going to be putting it on the side, which is the lesser of the two. And the lesser of the two here is our credit side. So whatever difference we get here, 27,800 minus 25,100 would give us 2,700, and that would be going on our credit side as our balance CD, right? So you would now note if you're supposed to add everything on your credit side, it would equal to 27,800. After we calculated our balance CD, we would carry the balance down diagonally to the opposite side, and we'll call it our balance BD, or ending balance. So I hope you would have understand this step of closing accounts. And the steps are really 5 steps. First, we find the total of both sides, right? Which is the larger of the two. The larger of the two, you'll put in the total box on both sides. Then, based on what you'd have calculated prior, you're going to find the difference. That difference you will insert on the side, which is the lesser of the two, and call it our balance CD, right? You're doing that because we want both sides to be balanced, to be equal. So if you're supposed to add both sides after putting in that balance CD, you should end up with the same totals that you would have inserted. After you've inserted your balance CD, you now carry that balance down diagonally to the opposite side and call it your balance BD. So given that we've closed those accounts, let's continue with the others. So we'll be closing our office supplies, our office furniture, our accounts payable, and our salary expense. And remember the steps. We're totaling both sides of the T accounts, finding the larger total, putting that total in the total box on both the debit and the credit side. We're calculating the difference between the two that you'd have obtained in part one from totaling both sides. Then we're inserting that difference, calling it our balance CD on the side which is the lesser of the two to total it. Then carrying that difference that we would have found, we're carrying that difference down diagonally and calling it our balance BD or our balance BF. You can notice that for accounts where there was only one transaction, it is very simple to do. You just carry the total down, right? So I have here accounts that are closed, general ledgers that are balanced and closed here. So this is what your office supplies account, your furniture account, your payable account, and your salary balances should look like and on the respective sides. Or other accounts here, accounts receivable, service revenue, advertising expense, we have them there. We also have our equipment, our utilities, we have, and our withdrawals account, right? So this should sum all our accounts that we would have had, that would have opened, all our ledgers that we would have opened. So let's move on to the trial balance, because remember, we cannot successfully do our trial balance without closing or ledger accounts. So this is what our trial balance looks like. The heading we have, remember, for any statement that you're doing, you need the name of the company, the statement that you're doing, and what we're doing is a trial balance and the period for which we're doing it. The details of the trial balance includes the accounts and explanation, and we have a debit column and a credit column. And as you can see, our trial balance looks a lot like our journal, our general journal. It has that same format. So what exactly goes in our trial balance? Let's look back. So we would have closed our accounts, right? We would have closed all our accounts, and what you're seeing here is just a few of them. And we would have note on what side we have our final balancing figure, or balance BD. We would have note that side. So what exactly goes in our trial balance is the name of the accounts and whatever side that balance is on. If it's on the debit side, you would put the amount in the debit column. And if it's on the credit side, we put that amount in the credit column. So let's look at building account. We're seeing that our building has a debit balance because that final balance BD of $30,000 is on our debit side. So I have here the final prepared trial balance, but let's look for these so you understand. So we're going to look for building, and if we look up, you see we're building and it's on the debit side, $30,000. Let's look for capital. We're seeing a credit balance of $55,000. Let's look for capital. It's on the credit side, $55,000. Let's find another one, cash. You're seeing a debit balance of $2,700. We're seeing there cash on the debit side, $2,700. And if you close all your accounts and we have put it down diagonally, that's the side where we're putting it on here. I have listed our trial balance in a certain order, but you don't. You can just write them. So your first would have been building and capital and cash, because that was involved in the first transaction. But I had looked at the question prior and I would have set it up a little bit like this, right? So here we're seeing we would have put in all the journals, all the accounts that we would have done, right? They all go to our trial balance, because from our trial balance, we will do our final accounts. So once we put in all of our accounts and we know total, the debit column and the credit column, and our total here should be the same. It should balance, because remember initially, if our trial balance is not balanced, our final accounts won't be, because we use our trial balance to do our final accounts. So going back to the question, so we would have done requirement 1, requirement 2, and just now requirement 3. So requirement 4 states prepare the income statement, statement of owner's equity, and the balance sheet. So remember I had said per that, what do we use? We use our trial balance to prepare these final accounts. So we're going to look at our trial balance, and we're going to, on each account, we're going to state which final account would it go in. What is it? Is it an asset? Is it a liability? Assets and liabilities goes to or balance sheet. Is it revenue or is it expense? Those go to our income statement. Does it relate to our statement of owner's equity? And the things that go there is our capital. We have additional investments. We have the net income that we would have calculated from our income statement, and or withdrawals. Those go in our statement of owner's equity. So based on this listing that we have here, we're going to go through each one and highlight where they should go, which will make it a little bit easy for us in preparing the final accounts. So the first one is cash. And we're saying cash is an asset and it's going to our balance sheet. I'm already noting balance sheet BS, and what the colon is, you have A for assets. If it's the balance sheet BS, if it's a liability, you will see L at the end. If it goes in the income statement, IS. If it's revenue expense, it's the colon R or E. Right? So let's look at accounts receivable. That's going to our balance sheet because it's an asset. Office supplies, also going to our balance sheet because it's an asset. Office furniture, also going to our balance sheet because it's an asset. Building, also going to our balance sheet because it's an asset as well. Accounts payable, that's going to our balance sheet, but it's a liability. Capital, where is that going? Or statement of owner's equity or statement of equity. Withdrawals, going to our statement of equity. Service revenue, that's going to our income statement, and that is revenue. Salary expense, income statement, expense. Equipment expense, income statement, expense. Advertising expense, income statement, expense again. Utilities, the same. Income statement, and it's an expense. So here we've identified what our accounts are and where they should go in what statement. So let's move on to our statements. The first one being our income statement.